Okay, let's just dive right into this. Welcome to today's explainer. We're going to pull back the curtain on the hidden, high-stakes world of market risk. We'll be unpacking the, frankly, wild mathematical gymnastics that financial institutions use to protect their money, why those exact models sometimes fail spectacularly, and how all of this trickles down to impact everything from global stock indices to the actual physical buildings we live and work in.
Let's start with a little scenario. Say you decide to invest your hard-earned cash in a totally normal, everyday milk company. You're probably thinking, oh sure, I bought shares in a dairy farm. What could possibly go wrong? I mean, the cows eat grass, they make milk, people buy the milk for their cereal, boom, done. This sounds foolproof, right? Literally the safest, most boring investment you could possibly make.
Well, surprise. You dig a little deeper and you find out your quiet little milk company is actually carrying out some decidedly non-dairy activities. Turns out they're gambling on complex derivatives and foreign exchange futures. Now, how would we even know this? Well, in the US, the SEC mandates that corporations detail how their results directly depend on financial markets, and they have to put this in their annual reports on Form 10-K. This rule is designed for exactly this kind of situation, to warn an innocent investor that their trusty dairy farm is actually taking massive financial gambles right behind the scenes.
So what kind of systemic trap did our hypothetical milk farm just fall into? Let's move to Section 1, the core concept. What exactly is market risk?
The formal definition goes like this. Market risk is the risk of losses in positions arising from movements in market variables like prices and volatility. Pretty straightforward, right? Basically, every business inherently takes risks based on two main things. First, the probability that an adverse circumstance will actually happen. And second, the ultimate cost of that circumstance if it actually does happen. Risk management is simply the study of how to control those risks and balance them against the possibility of making a gain.
Now, market risk isn't just a monolith. It comes in a whole bunch of different flavors. You've got equity risk, which is the danger that stock indices, think the Eurostoxx 50, or their implied volatility will change. Then there's interest rate risk, which is tied to things like LIBOR or Euribor. Currency risk impacts foreign exchange, like the euro to the US dollar. You've also got commodity risk, hitting physical goods like corn and crude oil, or, in our case, cow feed. And then it gets even deeper. You have more complex structural risk like margining risk, which comes from uncertain future cash outflows due to margin calls, plus shape risk, holding period risk, and basis risk. Essentially, all of these represent the different ways that prices, or the implied volatility of those prices, can just wildly and suddenly change.
All of this brings us to the idea of market exposure. In finance, exposure is really just a measure of the proportion of money invested in a specific sector. Think about it like this. If we have a total stock portfolio worth $500,000 and $100,000 of that is parked in semiconductor stocks, then this portfolio has a 20% market exposure to chip stocks. It's a really simple mathematical way to pinpoint exactly where your vulnerabilities lie, whether that's in silicon chips or, well, dairy cows.
But of course, knowing your exposure is only half the battle. How do banks, investment firms, and our rogue milk company actually attempt to calculate their potential loss? That brings us to Section 2, measuring the carnage and finding the magic number.
Traditionally, the convention used to measure potential loss is something called value at risk, or VAR. It is a very well-established, super widely accepted metric in short-term risk management practice. But, and this is a massive but, VAR relies on some highly problematic limiting assumptions that seriously constrain its accuracy.
To see why, let's compare VAR with its primary alternative, CVAR, or conditional value at risk. The first big flaw with standard VAR is that it assumes the composition of the measured portfolio remains totally unchanged over a specific period. Now, for super short time horizons, sure, that's reasonable. But over longer stretches, portfolio positions naturally change, which makes the VAR of that hypothetically unchanged portfolio basically useless. Plus, VAR is not sub-additive. What does that mean in plain English? It means VAR might falsely tell you that diversifying your portfolio is actually increasing your risk, which makes absolutely zero sense. Because of this mathematical glitch, it's not even considered a coherent risk measure. CVAR, on the other hand, fixes the math. It behaves coherently for general loss distributions, including discrete distributions, and it is sub-additive, so it's a much more accurate ruler for measuring true market risk.
But what happens when things get truly crazy? We need to slow down for a second, because this is where theoretical math hits the harsh reality of human panic. Let's look at Section 3, System Failure, when the math breaks down.
Honestly, you can think of standard risk models kind of like a weather forecast. They work perfectly right up until a Category 5 hurricane hits. Normal approaches like variance-covariance and historical simulation assume that historical correlations are stable. Basically, they assume that whatever happened in the past will safely predict the future. But during periods of extreme high volatility and market stress, those historical correlations completely shatter. It's incredibly intuitive when you think about a massive financial crisis. Instead of an upward trending market where some sectors win and others lose, suddenly all industry sectors experience a massive, simultaneous increase in correlations. Everything just hangs together. This phenomenon is known as asymmetric dependence, and it's exactly what takes down even the most confident investors.
So what's the solution? If variance-covariance fails during a panic, analysts desperately need an alternative. Instead of looking at historical averages, they run Monte Carlo simulations, which is essentially running thousands of random future scenarios using complex models called Vine cupolas, things like Clayton or rotated Gumbel cupolas. Now, without getting too deep into the mathematical weeds here, these models actually allow for that panic-induced asymmetric dependence. They account for the weird, lopsided ways stocks actually behave in reality, attributes known as skewness and kurtosis. Simply put, they measure how often things go wildly off the rails compared to a normal bell curve. If our ambitious dairy farms' risk managers didn't account for these sudden, extreme market shifts, their calculations could have a massive negative bias of up to 70% off the true risk value. They'd think they were completely safe, literally right before going bankrupt.
With models breaking and massive biases threatening the entire financial system, how do global regulators step in? That brings us to Section 4, the regulatory response, keeping the chaos in check. Way back in January 2016, the Basel Committee set revised minimum capital requirements for market risk. You'll hear this revised framework called the Fundamental Review of the Trading Book, or FRTB. It specifically addresses the glaring deficiencies in both internal models and standardized approaches for calculating market risk capital. Crucially, the FRTB clearly defines the boundary between the trading book and the banking book. It also shifts the use of value at risk toward measuring expected shortfall under stress, and it directly addresses the very real danger of market illiquidity. Basically, it's the ultimate regulatory rulebook designed to keep the chaos in check when the math inevitably fails.
Okay, we've spent a lot of time on lofty financial theory and banking regulations. Let's bring this all back down to earth in Section 5, the real-world impact, market risk for physical investments. Because, market risk doesn't just live on glowing Wall Street screens. It lives out here in the physical world. Physical investments face serious market risks too. Real capital, like real estate, can suddenly lose its market value. Physical cost components, like fuel costs for a business, can wildly fluctuate with market prices. But here is the flip side, and I think this is truly revelatory. You can actually use physical capital investments to reduce your market exposure. For instance, investing in energy efficiency doesn't just lower your utility bill, it actively reduces your exposure to fuel price risk. Why? Because a much smaller cost component of your business is now susceptible to those sudden price fluctuations.
The really crucial point here is how we value that specific reduction in risk. We can actually calculate this using financial methods, exactly like we do for stocks. Using an approach known as the Thoman and Sepinen method, research shows that the value of this risk reduction from energy-efficient buildings is approximately 10% compared to the direct cost savings alone. Think about that. You're not just saving money on gas, you are effectively buying a 10% buffer against global commodity volatility. That is a huge deal.
Which brings us to our final thought for this explainer. We've seen how boring dairy farms can secretly be gambling on derivatives. We've seen how standard value at risk models fail to account for changing portfolios, and how historical correlations completely collapse during a crisis, forcing analysts to use complex Monte Carlo simulations just to find actual truth. So, I'm going to leave you with this question to ponder. If the most advanced mathematical models on Earth can just break during a panic, how exposed is your supposedly safe physical and financial portfolio right now? It might just be time to check your own market exposure. Thanks for joining me, and keep questioning the numbers.